This is Business Morning. Welcome to the show. I'm Ladi Williams.
And I'm Chimeze Obi Iwago. Well, let's tee off with updates on the global oil market as prices edged higher this morning, hovering near 11-month high hit the previous day as Saudi Arabia's pledge to make voluntary cuts to its output continued to boil the mood in the market through worries over slower fuel demand cap gains. Brent crude climbed 2 cents to $54.40 a barrel after closing slightly higher the previous day. It touched $54.90 on Thursday, the highest since February. U.S. West Texas Intermediate also gained 2 cents to $50.85 a barrel. The contract closed up 0.4% on Thursday after also hitting its highest since February at $51.28. Both benchmarks are on track for gains of about 5% for this week.
And back here, latest data from the National Bureau of Statistics shows a total of 9.28 trillion naira was spent on the importation of manufactured goods in Nigeria from January to September 2020. Manufactured goods imports into the country rose significantly in the third quarter of last year as the manufacturing sector was hard hit by the COVID-19 disruptions, border closure, and foreign exchange scarcity. The sector contracted in 6 months to October amid the economic fallout of the pandemic. According to the data, the manufacturing goods imported into the country in Q3 were valued at 3.83 trillion naira, up from 2.78 trillion naira in Q2 and 2.66 trillion naira in Q1, according to MBS. Manufactured good imports increased in value by 23.18% in Q3 compared to Q2 and 23.47% year on year.
And of course, the federal government has directed the Nigerian Electricity Regulatory Commission to suspend the planned biannual adjustment in electricity tariff between 2 and 4 naira per kilowatt until the Joint Ad Hoc Committee concludes discussion by the end of January. In a statement released yesterday, the Minister of Power, Sali Maman, says the suspension will allow the outcome of all resolutions from the committee to be implemented fully. He adds that the deliberations between the federal government and the labor centers have led to the accelerated rollout of the National Mass Metering Plan, clampdowns on estimated billing, improved monitoring of the service-based tariff, and the reduction in tariff rates for bands A to C in October 2020. Well, I guess it's good that they are taking this decision to, suspend this. I hope they will do same with this NIN thing.
Exactly, to ease the pressure. But more issues have continued to come out from this directive to link the NIN to SIM cards. This time, the Economic and Financial Crimes Commission has warned Nigerians against selling their national identity numbers owing to the risk of being arrested and prosecuted for any act of criminality carried out with their NIN by criminal perpetrators. In a statement by the head media and publicity of the commission, Wilson Uwujaran, some unscrupulous persons are cashing in on the exercise to induce enrollees to sell their NIN for a fee. He maintains that it is not only illegal to sell their NIN, but stand a huge risk if a crime is committed, whether or not they are directly responsible for such crimes. He urges Nigerians to desist from selling their NIN and to report anyone seeking to buy and to the nearest office of the EFCC or other law enforcement agencies.
You see, when I saw this story, I was just wondering.
Yeah.
I mean, I was just imagining myself, and then I have to sell my NIN to someone. I just can't really get it. And I think that is why I was listening to one of these comedians on Sunrise talking about the fact that this name registration thing seemed to be creating more problems than we're trying to solve. I mean, the government is saying, look, we want to stop this pandemic. The cases are rising, and yet we're making people go out there and continue to spread this thing. Perhaps we should stop it. And now this is a new thing coming out of it. I'm sure they are trying to fight this insecurity issue. But yet, Nigerians, it seems, when you do it this way, There's another way out there.
Selling
But
NIN
let's
numbers.
just hope that we get
Incredible.
it right. Okay, now economic think tank Financial Derivatives Company is projecting Nigeria's inflation rate to speed up to 15.4% in December from 14.89 recorded in November last year. That's the highest level in 3 years. FDC, in its inflation forecast report, says the increase by 0.51% will be largely driven by Forex rationing, output and productivity constraints, higher logistics and distribution costs. The report adds that the rate of inflation rise on a month-on-month basis is expected to decelerate to 1.2% from 1.6% due to the effect of the land border reopening and harvest season. The survey also reveals a reduction in aggregate demand in December 2020 relative to 2019, with disposable income being negatively affected by the electricity tariff hike, general reduction in subsidies, and improved tax mobilization.
Well, as 2021 continues to unfold, economic analysts and corporate bodies have continued to give their projections of the expected growth of the Nigerian economy in 2021. Analysts at United Capital expect the GDP growth to rebound by 1.7% to 2.0% this year. Wale Olusi, head of research and United Capital, joins us next. You stay with us.
You stay with us. Head of research at United Capital, Wale Olusi, joins us now. Good morning, Wale. Thank you for joining us, and Happy New Year to you.
Good morning. Thank you for having me. Happy New Year.
Now, the World Bank expects growth in Nigeria to resume at 1.1% in 2021, that's this year, but you see a 1.7 to 2% growth. However, the federal government expects a 3.2% growth. What for you is driving this optimism?
Okay, thank you for having me once again, and Happy New Year. Well, I don't think it's really an optimism per se, because if you look at the Nigerian economy and its capacity, it's an economy that can do more than 5% growth, if things are actually, very normal and the normal policies are in place. But at 1.7%, what we are seeing is a situation whereby an extremely low base effect from last year's economic recession is going to, help the economy rebound in 2021. Again, we are also seeing improvement in oil prices, which hit a record low of about $20 to $18 per barrel last year. And then, the most of the economy is going to be, rather opened 2021 compared to 2020. So if you look at how, all of these factors, are pulled together, we think the economy might be able to rebound by about 1.7 to 2% in 2021 because of that low base effect from last year. I mean, last year at minus 6% in Q2, that was the lowest level the Nigerian economy has ever reported a decline. So that should be able to pull the economy up 2021.
Okay. So, Wale, we've seen some improvement in the oil market, but let's not forget it's a volatile market. And of course, Nigeria, being an OPEC member, is guided by the quota. Nigeria's oil production has fallen, currently at 1.6 million barrels per day. Shouldn't that be a concern?
It is a concern, but the truth actually is that oil accounts for about 10% of the Nigerian GDP. If you look at what the MBS is using to calculate the GDP, oil is about 10%. But the significance of oil is really about the, FX earnings. When oil prices improve, the sentiment for the Nigerian economy improve. Typically, foreign investors look at Nigeria differently when oil prices are improving. So yes, there's a lower production. If you put that against the oil price, it may not be able to, pull the economy out significantly. But the central bank gets more FX, the external reserve improves, then it feeds into other critical sectors such as trade, such as manufacturing sectors, which are also, significantly affected last year. Now, when FX earnings improves, you start seeing improvement in manufacturing activity that depends a lot on importation. Trade activity also starts improving, and then manufacturing and trade alone, or the services sector put together, account for more than 60% of the economy. That should be able to allow us rebound. Now I need to state clearly, 1.7%, 2% is not where Nigeria should be in terms of growth. If you compare that to growth per capita income, that is growth per head, this economy is still struggling. So 1.7 is not really growth. What we need is growth that is at least mid single digits for
Okay.
us to start seeing Nigeria the way we want it to be.
All right, Wale, let's look at some other concerns as raised by the World Bank. Talked about falling public investment due to weak government revenues, constrained private investment due to firm failures, and of course, subdued foreign investor confidence. So how can Nigerian economy transition into an investment-led economy in the midst of all of these uncertainty?
I mean, really, it's really about the policies we put in place and the kind of impression we are creating in the mind of foreign investors, who want to come and invest into this economy. I think if the policies are right, for example, the FX markets remain, technically inactive for going to about 10 months now, because, if you look at what is happening in the I&E window compared to pre-COVID level, that market is not really opened. FDI, was able to increase slightly in Q3 of 2020. But if you look at it, it's still at very, very record low. In the last 3 to 4 years, FDI has, continued to average about $2 billion. Before then, it was way more than that. Most of the foreign investment that we see in Nigeria are mostly hot money, what you call foreign portfolio investment. They only come in and exit immediately. FDI will not come if they don't think the policies favor their investment. So we need to look at critical sectors of the economy, such as the power. And I think the government has started doing, things. As of last year, the pandemic actually forced us to take some critical reforms in for example, the oil and gas sector, where the downstream sector seems to have been, deregulated now. The pump price have gone to 158 or thereabout. If you look at the electricity sector, the government is also taking critical steps there to make sure that tariff, reflects the cost. And once, that sector becomes profitable, you'll be able to attract more investments into that sector. But we need to also look at other sectors, such as the agri. I think, a more holistic approach really needs to be taken to look at that agri sector. The sector has continued to report, on the average in the last 5 years, about 3% growth. Last year was about 1.4%. Now, for that agri sector with a lot of potentials, we need something more holistic, something more far-reaching. That sector should be reporting growth above 7%. Nigeria wants to account for over 5%. So, I mean, we need to look beyond oil, yes, but we need to take bolder steps across the sector. The manufacturing sector is another sector that we need to look at critically, and we need to create a lot of jobs for Nigerians.
Okay, so looking at the 2021 budget, how much impact do you think it will have on our recovery efforts?
Well, the 2021 budget is bold. Government wants to spend about 13 trillion. It has been passed as of 31st of December, which is laudable, by the way. And of course, the Finance Act has also been, passed along with it. Yeah. Our own challenge is the fact that government wants to raise the revenue of about 7 trillion. I mean, we struggle to see where the revenue is going to come from. Most of the revenue estimates for both non-oil and oil over the last couple of years have consistently underperformed, their estimates. So the only challenge really is where the revenue is going to come from. But I think the intentions are right, but the revenue needs to come from somewhere. Last year, when the Finance Act was initially launched, all of those non-oil revenue assumptions were all reviewed so that government can mobilize non-oil revenue aggressively. But with the pandemic, it affects corporate earnings. It also affected oil revenue. and most of the year, budget performance was considerably below estimates. So we think that might also happen this year. So we think fiscal efforts should continue, but most of the spending will probably depend on whatever we can raise in terms of revenue, and mostly on borrowing.
All right, Wale, before we let you go there, the Central Bank's Monetary Policy Committee will be meeting later this month, the first one for the new year. What is your expectation? What sort of responses are you hoping to see?
Well, thank you for that question. We think the monetary policy, based on the last meeting they had, clearly are concerned about the recession that we saw last year, and they've supported central banks' heterodox monetary policy to keep interest rates low. The intention of that is to make sure that there's enough liquidity in the system, there's enough borrowing going on among the corporates, so that consumption can also improve, so that growth can come back. We think in the next MPC meeting, they will review their decisions at the last meeting. We think the galloping inflation will be a concern for them. So our suspect is that they may want to keep policy variables at current level for now, or maybe in their March meeting they may begin to look at how they will start tweaking policy variables to support maybe faster growth, or recalibrate inflation rate that has been jumping almost over the roof, so that it can come back. And that might mean that they want to change their decision to keep increasing interest rate, because inflation rate at about 15% does not support growth. They need to look at that critically.
All right. Thank you very much, Wale Olusi. We do appreciate your time always. Thank you.
Thank you for having me. Good morning.
And President Muhammadu Buhari on the 31st of December 2020 signed the Finance Bill 2020 into law. And what does the act say? That will be a conversation with Ayodeji Ebo, Chief Economist and Head of Research and Strategy at Greenwich Merchant Bank, after the break.
Welcome back. Now joining us to discuss the Finance Act 2020 is Ayodeji Ebo, the Head of Research at Greenwich Merchant Bank. Hello.
Hello, good morning.
Good morning. Thank you for joining us, and Happy New Year.
Yeah, Happy New Year. Thanks for having me.
Yeah, so let's get into it now. The 2020 Finance Act has been signed into law. Let me get your thoughts on the act.
Okay, thank you. The Finance Act, it's a fiscal legislation that helps to itemize or provide guidance on some of the tax law, tax regulations, rates, incentives, and levies that should guide the business environment for the year. And this is commendable because this is the second consecutive year that government would be presenting that or signing that into law after over 20 years of non-amendment. So we that this is positive, provide clearance, and also help you most times identify some of the tax revenue gap that government is also trying to solve, and keeps most of this tax law and policy aligned with global best practice.
Now, Ayo, there's been a lot of conversation about unclaimed dividends and dormant account balances in the 2020 Finance Act. Now, the Finance Act states that unclaimed dividends of listed companies and dormant account balances in banks, unutilized for 6 years or more, are to be transferred to an unclaimed funds trust fund and will be managed by the Debt Management Office. What's your take on this?
Okay, very interesting. The issue of the unclaimed dividend has been the front burner of the Securities and Exchange Commission in the past few years, but I think not much has been achieved based on the process. And also looking at it from the bank angle for dormant accounts or dormant balances that has been accounts that have been dormant for 6 years. So starting looking at it from the investor's perspective, the unclaimed dividend affects the capital market investors. We feel that we still expect some form of clarity around how claims will be made. Yes, the government has promised that interest will be paid on this, which we feel that that is positive because currently no interest is being paid on the amount that is being held, even when you claim it. But there needs to be clarity to provide confidence. And because the liability is also for the government, is also in Naira, so there's no cause for alarm. These funds would always be made available, but the process has to be seamless. And looking at it from the bank perspective, which is the major part of it, when you look at total deposit within the banking system is around 35 trillion, and that's when if we assume it should be that, though there's no official figure around the amount of dormant balances, but maybe close to 10%. So that's very significant. And if government will be assessing this, it means that the amount of government liability would also increase. And now with also the promise that interest will be paid, so debt servicing would also skyrocket, and which will not be, which is looking unsustainable based on our actual revenue performance in the past.
Ayo, please, let me get more clarity on this, talking about interest being paid on it. Who gets this interest? Because if we understand what unclaimed dividend is, I mean, it could be someone who has shares and then perhaps you are dead or you don't even know. Okay, so who gets this interest?
I would presume that it should be the investor that should get the interest because it's the investor that have not been able to have access to those funds for the period of time. So it should be I would presume that it should be the investor that should get it. And also for customer, for the dormant accounts, that looks a bit tricky, but I believe that for the dormant account, maybe a base interest rate will be paid, or maybe will be split between the banks and the customers, because the banks is also holding those funds in custody for the customers.
Okay, so the Act states that small and medium companies engaged in primary agricultural production may be granted pioneer status for an initial period of 4 years and an additional 2 years, making a total of 6 years. Is this good enough?
Yeah, I think this is a step in the right direction, because if you look at the structure of the Nigerian economy, the small and medium scale enterprise accounts for over 50% of business activity as well as employment. So what government in essence is trying to do is to provide incentive. And looking at the agri space, that contributes over 20% to GDP, and in terms of employment contributes over 25% to employment. That is very significant. So if we can achieve a major boost within this sector, it would have a significant impact on GDP, it would have significant impact on employment, and that will reduce insecurity. Looking at the agri space, there needs to, part of what government in essence is trying to do is to provide incentives for more people to go into that space. But beyond just the production, we need to look at the processing, which we need to add value. If you look at the amount we spend in importing, it's very significant. And if we can also invest and provide those incentives across also processing, so that we have more investment within that space, that would also be good, and that would also increase employment rates in the country. So I believe that this is positive news for these small and medium scale enterprises. But beyond just having this in the act, I think maybe the NIPC should also broaden this, take this up and provide the process, the access of how people would be able to access this, provide some form of awareness, because there's always that knowledge gap. So a lot of the SMEs, some of them don't have access to the media, and they really don't know that some of these things are available. So there needs to be awareness. that takes me, if you look at the Africa Continental Free Trade Zone Agreement, when you speak with a lot of even the business owners, a lot of them are not aware of the opportunities within that space. So there needs to be significant awareness so that we can harness the opportunity within this space.
Okay, looking at this act, again, it exempts low-income earners on 30 naira per month or less from personal income tax. How does this benefit this group of people?
I think that this is going to be a cheering news for the low-income earners. And when you look at the pyramid, you have more people within that space. And if you convert the $30,000, look at it in 30,000 naira rather, if you look at it and convert it to dollars, it's around $2 per day, which is really very low. And with the high inflation rate, this savings of, when you look at the personal income tax based on the rate, they are supposed to be charged about 7% based on their income, and that's a bit of savings for them, which also reduces the burden and increases their purchasing power. So I think this is positive, and at least it's a form of relief amidst these current economic challenges.
So the act calls for a reduction of import duty on tractors from 35% to 5%, mass transit vehicles for transport of more than 10 persons, and trucks from 35% to 10%, a reduction of import levy on cars from 30% to 5%. How will this impact the automobile industry?
Okay, thank you. I think to just provide a bit of background, you notice that in 2014, the automobile policy was setting to see how the local production can be encouraged. As of 2019, it's been estimated that the capacity in terms of the capacity of the sector is over 1 million cars per annum that is needed. And when you look at production, it's still around 15 to 20%, which still leaves that significant gap. So then the tariff was increased to about 35% for both used, that's the import duty was increased to 35% for both used cars and new cars. So what, in essence, this is saying is for used cars, what you have is import duty. So this does not affect, what government is reducing does not affect those that are importing new cars. It will still remain 35%. But for used cars, you have about two main levies. You have the import duty, you have the import levy. Import levy is the part that has been reduced from 30% to 5%, which means that effectively reducing it from about 65 or 70% to about 40%. And that's for new cars, to encourage maybe the use of new cars. So by and large, also looking at it from some of the commercial vehicles that would also has been reduced, and also equipment for agric, that's tractors. This is also to encourage, it's a form of subsidizing production, which yields more multiplier effect or higher multiplier effect than trying to subsidize consumption. So I think this is also positive. And if we look at in summary, what most of these, the item that has been highlighted is, we know 2020 was a challenging year for Nigeria amidst the COVID, and we're also trying to survive. So government is trying to provide some form of relief, some form of support, so that the rate at which we'll be able to recover will be faster than anticipated.
Yeah, you talked about this actually trying to encourage people to go for new cars, but just wondering how many people can actually afford new cars?
Yes, that's you have. I would say you have a point there. But what government is also trying to do is also trying to protect the local manufacturers. So there's this law, this ECOWAS law on emission that prevents Nigeria from importing cars that are above 5 years. That would also impact on the cost of used vehicles, and that will not that would shift may shift also focus to new cars as well as locally produced cars in Nigeria.
On stamp duty, the Act has scrapped stamp duty and replaced it with electronic money transfer of 50 naira and applicable to transfer of 10,000 naira and above. Your thoughts on that?
Yes, I think what in essence it's what I think it's the Act that portion is trying to do is to ensure that for the stamp duty, which was also 50 naira, which more for bank transfer. Now it's more of nomenclature. It's been changed to electronic money transfer (EMT), also at 50 naira. But also looking at the sharing formula. So the stamp duty have all been shared with the gross monthly. What I'll say at the gross monthly allocation shared at the FAC meeting on a monthly basis at the rate of 15% is kept by the federal government, while 50% is given to the state and 15% to the 35% to the local government. But what this Act is now saying is that 15% comes to the federal government and 85% goes to the state. So this may also be seen as a way to boost the allocation that goes to the state on a monthly basis. If you look at the average FAC allocation, is been around 600 billion naira, from the high of over 700 billion before the COVID period last year. So I think it's also a way to provide that support, because there are some of the states that are mainly driven by the FAC allocation, ability to pay salaries. They are driven by some of those events before you see major activities in those states.
Okay, let's look at aviation now. Commercial flight tickets have been exempted from VAT. How will this affect the sector going forward?
Okay, I know this will be positive news especially for most of the customers or passengers rather, because if you look at last quarter, the price of flight tickets increased significantly. So that would also reduce that impact. And there are also other costs, because if you take an holistic view of that sector, there are a lot of challenges. The high cost, well, you hardly find any major airlines that is surviving a very long period. So there needs to still be an holistic overview or review of that sector to see how some of those major bottlenecks can be taken care of, so that their businesses are sustainable. They are more sustainable in the future.
Now, Ayo, generally, about 20 new key changes were made in this new Finance Act 2020. Are there any of them of concern to you?
Yeah, I think that for me, I think for most of them are in line to see how the government wants to provide support for the economy, for the citizens. And there's this other area that we've really not. When you look at the budget 2021, you will discover that about over 50% of the revenue is being projected from government-owned enterprises. And they increased the amount of government-owned enterprises that will be captured to about 55. And what in this act, what they are saying, what it has said is that, or what it stated is that on a quarterly basis, the operating surplus will be moved. So it will no longer be annual basis. So that would also provide some of control for the government, so that they can also try to meet up with their target within that space. Because when you check the past performances within the independent sources or government agencies, MDAs, sources, you always see that they always lag behind significantly within that space. So I think this is an annual legislation that would help to support. So if there are any downside, some of those things would also be taken into consideration in the new Finance Act that will be signed into law in 2021. So I think that would be of any major concern.
We appreciate your time always, Ayo DG. Thank you.
Thanks for having me.
Thank you.
All right, let's look at Thursday's trading at the equities market. Let's talk to Muhammad Kayode, stockbroker at APT Securities and Funds. Good morning, Mr. Kayode. Thank you for joining us.
Good morning. It's a pleasure to be with you there.
Well, of course, the all-share index continues on the positive territory. But how would you describe what happened at the market yesterday, particularly regarding the activity recorded, which was boosted by Champion Breweries?
The activity in the market is quite kind of on a cautious mood. The investors are very cautious, and everybody is watching the market. And if you discount what happened in the Champions Brewery, you realize that the market traded about 2.5 billion value yesterday, which is very low to what we used to experience in the market. And this shows that everybody in the market is trying to watch what the outlook is going to be like. For the fact that the analysts have not come out to design or tell us the clear outlook of 2021 is going to be like, and the stock exchange also has not come out to tell us what the outlook is going to be like. So investors are a bit conscious about the activity in the market. And what happens in Champions Brewery is just major investor diverting investment, and that's to the tune of 1.9 billion shares and value at 4.9 billion naira worth of investment.
Okay, now a new trading day has started off. What is it looking like as at this morning?
The new trading day, I expect that it's going to display what we have last week, what we have last trading day, that is yesterday. So we should expect the market to be on the cautious mode where the volatility is very low in the market. We see a kind of a low-key activity in the market because of what has happened within the week, and there is no much information to drag it negatively or whether to the southward or to the northward. So what we expect that the market should continue in that move for now.
All right, thank you very much, and we wish you a profitable day at the market.
Thank you very much.
And for updates from the street of London, let's talk to Juliana. Hello, Juliana.
Good morning, Laddie. Good morning, Chimeze.
Good morning. Thank you for joining us. So National Express is to suspend its entire network of coach services across the UK from Monday due to the latest COVID-19 travel restrictions. This must be putting a lot of pressure on commuters. What happens to those who already booked to travel?
Well, unfortunately, not to sound too crass, but we are in a national lockdown, so nobody should be travelling but for essential reasons anyway. And that's one of the reasons why this National Express, as well as Megabus, which is another big coach tour operator in the UK, have decided to suspend travel because they're just not getting enough passengers. They didn't have enough passengers throughout 2020. They would have hoped to have regained some of that lost revenue at the start of this year. But alas, COVID is completely out of control here in the UK, so they have decided to suspend all travel until at least the beginning of March. That's about 7 weeks now. They have put out a statement saying that any passengers that do have tickets and want a refund can do that by the 1st of September. So we are seeing this similar trend across lots of passenger commuter services.
True, nobody should be traveling at this time, but retailers are calling for more financial support from the government after shopper numbers dived more than 2/5 last year. What nature of support are they asking for now?
Well, there are lots of things that they want. Helen Dickinson, she's actually been speaking to the media this morning. She's the chief executive of the British Retail Consortium. They represent hundreds of retail outlets in the UK. We've discussed this extensively even before the pandemic. The British High Street was really struggling, failing to compete with online e-commerce, fast fashion retailers that seem to have swept up the 18 to 24-year-old age bracket that was spending all their spare change online. And then COVID-19 struck last year, which meant so many of these high street parks, retailers were closed. And then when they were hoping to get back and reap the rewards of the golden quarter, the final quarter of 2020, we had that November lockdown, which meant numbers plummeted throughout the whole year. Numbers were down 43%. In London, those numbers were much steeper. They were down by 58%. She's calling on the government to extend a property holiday tax for retailers. She said a third lockdown will be one too many for some businesses. Rent bills continue to weigh heavily, and the threat of a return to full business rates liability in April still looms. We are expecting a budget by the Chancellor of the Exchequer, Rishi Sunak, in March. Some say that's way too late. They want to hear from him sooner. Parliament was recalled last week because of this new national lockdown. So what retailers are hoping is that over the next couple of days, perhaps there may be more to come out of the coffers by the Chancellor to save retail in this country.
And on the Brexit aftermath, British retailers are concerned at new trade barriers being applied after last month's trade deal with the EU. Many traders now believe they will be paying taxes on exports and imports of certain types of food and clothing that are not fully made in Britain. What is the update on port activities now?
Well, the ports are still pretty free-flowing. There's lots of bureaucracy, lots of red tape. A lot of those who work in the haulage have said that really it's the invisible delays and confusion that's going to be the main cause for concern, not really the long queues which we've all been told would happen. Now, Michael Gove, he is a senior Brexit cabinet minister. He did say that we should expect to see some of the disruption perhaps in the second and third week of January, and now we are starting to see that, and it appears to be stemming from the rule of origin. Now, what was so monumental about the Christmas Eve deal is that Boris Johnson, the UK Prime Minister, did manage to secure tariff-free, tax-free trade between Brussels and Britain. But the rule of origin does mean that any UK company that exports to Brussels must make sure that if some of their products have components that are made outside of the UK or the EU, you will be charged for that. And you can imagine, considering China is the manufacturing capital of the world, there are so many businesses that have components that are made up from Chinese items, and they have to pay tax on that. So for many companies, it's just not worth it. We are seeing a slew of retailers that have said, for the meantime, they will stop exporting to the EU. So if you are in the EU and you want to buy something from John Lewis, for example, you can no longer do that because they are not delivering to that. Now, John Lewis is the biggest retailer thus far in the UK to say that they will no longer be sending their goods to the EU, though they haven't said that it's about Brexit. A slew of other retailers have said it's to do with that. So there is still so much confusion. It was a 1,225-page document. I haven't even got myself all the way through it. It is that complex, and the dust is beginning to settle. And as it does begin to settle, some retailers are just seeing it's just not worth it, which is unfortunate for those that would like to buy UK goods but are based in the EU.
Well, I guess we'll continue seeing the after effects of Brexit. Thank you so much, Juliana. Thank you for your time.
Absolutely. And, well, it's a new deal, so they'll have to keep understanding and learning what the whole details is all about.
Exactly.
All right, let's look at the debt and currency market. Let's talk to Bankole Odusoya, head fixed income at UBA. Good morning, Bankole, and Happy New Year to you.
Good morning, Happy New Year.
So tell me, what was activity like in your market yesterday?
It's been a quiet week. We've seen more activities on the short end of the Treasury bills curve. 9th March Treasury bills are trading at 0.15, and that's because there's so much liquidity in the system. We still do not have the debt issuance calendar from the Debt Management Office for the year or for the quarter. If that comes out, it sets a tone for what most investors in debt will be doing. So right now it's quiet and people are trading cautiously and trading short in the market, like buying short-term assets not longer than March maturity currently.
Okay, so it's a new trading day. How has the market started trading today, and what's your outlook for next week?
Okay, we are seeing interest on 9th March Treasury bills, 25th March Treasury bills around that short end. Well, it's been flat on the bonds end, that's the long-term end, because we expect that by next week, the Debt Management Office will release an offer circular. And when that comes out, we'll be able to see some more activities in the market. But going into next week and the end of the month also, we expect the Monetary Policy Committee to meet. So there's a lot of uncertainty and some level of reduced clarity. And you don't just want to take positions ahead of these events that I've mentioned. The Debt Management Office releasing their offer circular for the quarter, and then the Monetary Policy Committee meetings that will hold, most likely on the 25th of the month. So the next 2 weeks are quite crucial for the debt traders, debt instrument traders in the market. So that's why you're seeing more activities on the short end for people to manage their liquidity. They're trading on the short end of the curve.
All right, thank you very much, Bankole. Enjoy the rest of the day and have a great weekend and Happy New Year once again.
Thank you. All right, thank you.
Well, Adi, perhaps I would ask, what's the update on Bitcoin? You keep
Yeah,
tracking that market.
yeah, up 40,000.
As at this morning.
High, that's the latest high, 40K.
Well,
So
I don't have such money.
if you had bought the last time we talked about it, you'd be up.
No, I would have to wait until it crashes. Then perhaps I would have to think about it, because you're beginning to make me have interest in that market.
Right.
Thank you.
We'll see
All
how
right,
that goes.
that's a wrap on the program for today and, of course, for the week. Thank you for watching. I'm Chimeze Obi Iwagu.
And I'm Ladi Williams. Have a great weekend.